The big man himself, Warren Buffett, once famously said that whilst it's good to learn from your own mistakes, it's better to learn from other people's mistakes. And with the stock market about to post a huge negative return for the year, inflation running riot, and the crypto world crashing, investors like you and me from all around the world are making more mistakes than ever, meaning that we're losing more money than ever. So I've spent the past few weeks digging through stock market data and reading updates from other investors online to try and spot the biggest mistakes that investors are making. And believe it or not, I've found a bunch of mistakes that are actually closely related, meaning that mastering this one simple concept that I've discovered is going to be enough to stop you from making all of them, which is going to save you thousands of pounds over an investing lifetime. Because it's not a new concept that we're prone to making mistakes as investors. In fact, we make them all the time. In the 2020 Quantity Analysis of Investor Behavior Report, Premium Edition, they show this somewhat unbelievable data. Over the 30-year period running up to 2020, the S&P 500 posted an impressive average return of 9.96% per year, but the average equity fund investor only achieved a return of 5.04%, nearly halving the value. In fact, when you factor in the average inflation rate over that period, which is 2.4%, that leaves the average equity fund investor with a return of 2.64% per year, compared to 7.56% for the S&P 500. And if you compare a £200 monthly investment over a 30-year period with these two sets of returns, the final amounts come out to 105k compared to 252k. That would leave an investor missing out on around 150k of returns, or in other words, leaving 60% of the total returns on the table over the 30 years. But the report goes on to highlight a very interesting point, explaining that since 1984, approximately 70% of average investor underperformance occurred during only 10 key periods in which investors withdrew their investments during periods of market crises. In other words, we as investors are more prone to making mistakes when the market is in a state. And when you look at the S&P 500's returns year to date, yep, that means we're in trouble.
And after researching the S&P 500 further, I noticed the first huge mistake that investors are making.
So this chart on Yahoo Finance shows the S&P 500's value over the past 5 years. But what's most interesting is the trading volumes that you can see along the bottom. In the period from 2018 to 2020, when the stock market had relatively steadier growth, daily trading volumes remained in the 10 to 20 billion range. But in the COVID crash, trading volumes rocketed to 20 to 40 billion per day, as investors started to panic and sell out of their investments. And this just proves the point about underperformance that was raised earlier in the report. After that, trading volumes started to trend downwards throughout 2021, and that was matched by some relatively steady stock market returns. But throughout 2022, as the market has started its decline, trading volumes crept up again to the 20 to 30 billion range, revealing the first big mistake that a lot of investors are making right now, which is making too many trades. Now, there has been plenty of research into this topic, and this white paper is a good example of that, with the simple title, Do Investors Trade Too Much? I'll make sure to link the paper below because I'm not going to go into tons of detail, but the paper concludes that even after eliminating most trades that might be motivated by liquidity demands, tax loss selling, portfolio rebalancing, or a move to lower risk securities, trading still lowers returns. And investors are more compelled to make more trades during volatile periods for a whole range of different reasons. Some people think that they can profit from the volatility, jumping in and out of the market. But the problem is that as humans, we're just terrible at trying to time the market. And the more that we trade, the more that our fees start to rack up, which means that we lose more money. Although some of the selling can be explained because some people are just having to sell out to cover their costs because of the economic crisis. But this just shows why you have to have the right foundations in place before you start investing, including an emergency fund, which I know everybody talks about. That said, there is a better solution that I've found that will ensure that you don't make this mistake, but we're going to cover that later in this video because before that, I want to cover some real life scenarios.
So I took my research to social media, and within minutes I had found a common investing mistake.
So I've been scrolling for 5 minutes through a Vanguard investing group on Facebook, and I found multiple variations of the same post with different people all having the same problem. I'm paraphrasing here a little bit, but it goes along the lines of, I've been looking to start investing, but I've been stalling for 9 months as I'm not a confident investor. Also, the world is pretty messed up right now. I hear you. And I'm worried that things are going to get worse before they get better. So I might wait a little longer so that I can maximize my investment. So as a result of the bear market that we've seen throughout 2022, we're seeing another huge mistake that investors are making, which is either stopping investing completely or being too worried to start investing in the first place. Now, there is tons that I could say about this. Time in the market beats time in the market, all of that jazz. But all of that's fairly obvious stuff, and it's all pretty well proven by now. One thing that I do want to highlight though is that 78% of the stock market's best days occur during bear markets, or within 2 months of a bull market starting. And whilst that might not sound that important, this data from Morningstar and Hartford funds show that if you missed the market's 10 best days over the past 30 years, your total return would be less than half of what it could have been. The more days you miss, the worse it gets. And this data showed its relevance recently, when on the 9th of November, the S&P 500 posted a return of 5.54% in just 1 day. That's the highest single day return in over 2.5 years. And these days come out of nowhere, meaning that if you're sitting on the sidelines waiting for the right time to invest, you could miss out on a market rebound of say 10 or 20%, and before you know it, you've lost out on a load of potential gains. In reality, worrying about what's going to happen in the market over the next few months is a waste of time, especially because investing is a long-term game. Over the next 10 to 20 years, we're going to have more bear markets like this, and I hate to tell you, but there's nothing that we can do about that. We just need to learn to not be blinded by the short-term pain that we're seeing in our portfolios. The way that I personally see things, and this might help you too, is that the markets are just on a massive discount sale right now. I'm going to be investing all my life, so why not be happy that I'm going to be buying equities whilst they're cheap? And of course, there is another solution that I have to help keep you in check. But before we go through that, we need to uncover some more investing mistakes.
So I kept on searching online and found the other big mistake that people are making.
And this is one that I've seen a lot of, both in my comments and from investing groups online. Again, I found a few, but this one covers it pretty well. This investor said, I invested in Life Strategy 40, 60 and 80 a year ago, but 40 and 60 have performed poorly, so would it be better to accept the loss, sell, and invest in the FTSE Global All Cap Index instead? My investing horizon is 5 years. So in summary, this investor is invested in a couple of lower risk funds, including the Life Strategy 40 and 60 funds, which each have a significant allocation to bonds. But bonds have had a particularly bad year. In fact, they've actually done even worse than stocks, which is quite surprising because people tend to invest in bonds for stability. And this has made a load of investors make the mistake of wanting to change their portfolio or to increase their portfolio risk level, just because it's been a particularly bad year for bonds. Now, this is quite a complex one to tackle because there's quite a lot of different things going on, but I'll try to address them all. First of all, as humans and investors, we are suckers for making irrational decisions when we experience extreme emotions. And a lot of people right now are experiencing the extreme emotion of fear because of the state of the markets. But that's not to mean that investors are wrong to change their portfolio now, because a lot of investors have just realized quite how bad a bear market can be, especially after the bull market that we've seen after the COVID flash crash in 2020. So rightly so, they might want to adjust their risk tolerance because they've learned that they can't handle it, and that's fine. But investors wanting to add more equities just because bonds have had a bad year is risk management gone completely wrong. Especially in this case, when the investing horizon is just 5 years, switching over to 100% equities is extremely risky. And the only solution that I have to this mistake, which in fact acts as a solution to all of the mistakes that I've mentioned, and probably even more, is to make sure that you have an investing plan. Now, I know that this seems like a boring answer, but there's a lot of value to be had here, so please bear with me. I don't mean that you need to spend days or weeks creating spreadsheets and crunching numbers to make this big master plan that's going to dictate everything in your financial life. Because sometimes, even just giving it a conscious thought is enough for most people as a starting place, instead of just diving into investing blindly with no real strategy. Now, there are a load of different ways that you can do this, but at the very least, you should be addressing these issues. How much do you need for an emergency fund? And again, I know that people skip over this, but this year has proven that you can't underestimate the importance of it. You never know when an economic crisis like this could pop up, with jobs becoming unstable, the cost of living rising massively, and markets crashing. Emergency funds are made for times like these. They're not for the middle of bull markets where everything is rosy, it's for when bricks hit the fan. Secondly, you need to identify upcoming financial goals that you want to achieve. Again, this doesn't have to be massively rigorous, just lay out the key milestones that you want to achieve, how much it's going to cost, and how much time you have to get there. Then you need to think about how much you can invest and how often. Now, this doesn't have to be set in stone because circumstances can change, like we've seen this year, but it's good to have a rough idea as a starting point. This is essential to help you figure out how you're going to reach your goals and whether or not they are realistic. Then you can pair this up with the next step, which is to pick a portfolio with the right risk level. Because now you know your investing goals and how much you can invest each month, you now know your investing time horizon. And from that, you can figure out what returns you're going to need to reach your goals. This is going to mean that you can invest in a portfolio with the correct risk tolerance. And it's going to give you much more conviction with your investments, which is vital to keep you invested when times are rough. So by doing this simple task, you'll find it easier to keep your head cool during market downturns, your investing will remain consistent even when you have doubts, and you'll have the right portfolio risk level set so you won't need to make changes. And this is not a process that you have to do alone. In fact, I'd highly recommend getting help from a financial advisor just to get another pair of eyes on it. But don't underestimate how important this is, because as we've seen with these mistakes, the biggest thing standing between you and your financial goals is yourself. Although, even if you do have a right financial plan, there's actually one more thing that you need to understand if you want to reach financial independence, or whatever goals you may have. Because without knowing this, you could be leaving returns on the table, which is going to cost you tens or hundreds of thousands of pounds in the long run. And that's why you really need to watch this video here, where I show you the most important investing factor that is standing between you and financial independence.